One of the biggest negatives, I think, at times is trading stocks is too easy. Now, bear with me. I don't mean profitably trading stocks is easy. I mean the mechanics. It's just clicking a mouse at the end of the day. It's in, out, click, click, click. No broker's going to stop you. But what I want to talk about today is how not to trade stocks, because I think you got to think about the things not to do to stay out of trouble and preserve your account. Because if you're new, you're taking those losses, making those mistakes, all of a sudden, you slowly grind your account into oblivion. All right, everyone, before we get started, I'd like you to like, subscribe, share these videos with your friend, and also, especially if you're on YouTube, ring that bell to be notified as soon as we drop a new video or go live. All right, everyone. I am Tim Bowen, lead trainer with Stocks to Trade. Today we're going to talk about something that, I don't know. I wonder sometimes. I call this kind of stuff, quote unquote, not sexy. I think, it's just, it's fun. It's exciting to talk about big gainers and big moves and big profit numbers and focus on all that, amazing, I always think of like the comic book, pow, bang, stuff like that. Because that's what you see a lot of on social media is just like, bang, 50 grand, bang, 5 grand. Or, hey, I love Jim Cramer. But think about Mad Money, bang, he's ringing the button, sound effects. He never talks about how the mechanics of trading this stuff. And I think one of the biggest ways to improve is to focus on what not to do. At the end of the day, no broker will be like, hey, wait, did you do your research? Hey, wait, did you look at the chart pattern? Hey, wait, did you think about a stop? And by the way, do you have a goal on this stock? You're going to hold a day, a week, a month? Are you holding for 5%, 10%? They don't ask you those questions. You just hit the buy button, and if you got the buying power, you're in. So that, I think, is what a thing that really trips up newer traders is it's so easy. It's just boom, boom. And now you lose 100, lose 100, lose 100, lose 200, lose 250. Maybe you take a big loss and all of a sudden your 5 grand account is down to $500. Now I want to keep you out of trouble. One of the things you'll hear me say repeatedly on the podcast, on pre-market prep, on all these videos is when you're new, the biggest thing you need to focus on is quote unquote staying in the game. Okay? Because if you're down to $100 in your trading account, you're done. You're out. You're benched. You're in essence, you're out of business. Think about trading as a business. If you've got no working capital, if you've maxed out your credit lines, you got no money coming in, you're done. You're bankrupt. And if you're sitting there with $76.36 in your trading account, for all intents and purposes, your trading business is done. Okay? Did I scare you enough? All right. Let's talk about the 5 things to avoid doing right off the bat. By far biggest one, and I know it's so tempting, and I did it myself. Okay? Guilty. And that is following other people's alerts. I know. Listen, I talk about stocks every morning on pre-market prep. I'm talking about entries, exits, and it's funny. You'll see this too. And every now and then I'll start yelling at people because it's live. And I'm talking about a stock, and all of a sudden the bid starts moving up, the ass starts moving away, and I'm like, knock it off. It's first of all, it's pre-market. It's not about buying alerts. I'm talking about entries and exits, the how and the why behind the trade. So I get it. And there's a million alert services out there, and they're good. They're great, but use them as a learning tool, okay? It's not about following alerts to make money because you don't know, whether it be an SMS alert or a chat alert or a Discord alert or an email or a tweet. There's only so much information there. And I'm telling you, I know it seems like the path. It seems like the way. But you will never be self-sufficient. Because here's the thing. I think alerts are only a learning tool. Should only be learned from as a way to recognize what that trader was looking at. But ultimately, even if the alerts work, say you join an alert service and it works, ultimately, you're at the mercy of the alert service. What if they don't have an alert today? Or this week? Or next month? What if they retire? What if they change their style? What if they decide to not issue alerts anymore? You're now not self-sufficient. So even if you traded those alerts for a year and did well, now that alert service goes away or changes what they're doing or whatever, what do you do now? Now you're like, well, geez, wish I would have spent this year learning how to be self-sufficient. So use alerts to learn from. Don't use them as a trading strategy, is my point. That's the short answer at the end of the day. Biggest one, number 2, is FOMO. I mean, this kind of relates to number 1. And if you're not familiar with FOMO, it's fear of missing out. So many traders buy the top or get stuffed, as they say, because they see the stock moving, and they might have a plan. They might say, okay, I'm going to buy a pullback, or I'm going to wait for this first five-minute red candle, that 5-minute candle theory I talk about a lot, and I'm going to buy off the high and the low of that candle, or I'm going to risk a red to green or a green to red, and then all of a sudden stock goes higher, they throw their plan out the window and they buy, and invariably you buy the top because you changed your plan, because you're like, oh my gosh, this stock's up 20, now it's up 30. Now it's up 40. Now it's up 50. I got to get in because this might go 100%. And it's hard. Okay. And another analogy I use is I always call FOMO's like a dragon, in like the Lord of the Rings type scenario, which I think the dragon does get killed in Lord of the Rings, doesn't it? Check me on that. Anyway, I should know Bilbo and those guys. But anyway, but I always think of the dragon as like undefeatable, indestructible. And you can battle that dragon. You can keep him chained. You can keep him locked under the mountain, but you just need to control him. You will never defeat him, but you can manage FOMO by sticking to your plan and sticking to key levels for entries and exits. Those VWAP holds, those dip and rips, those breakouts, those green to reds, those red to greens, all those patterns that I talk about all the time, especially on pre-market prep. Number 3, just not doing your homework. I know there's this, I think, fallacy that, day trading, and you'll see this a lot. Oh, it's just trading the price action or trade the ticker, bro. And, you hear that kind of stuff. And yes, to a certain extent, you're just trading a trading vehicle. I mean, these stocks aren't investments. You're not visiting the office. You're not going through the balance sheet. You're not visiting their dealers, talking to the supply chain, okay? You're not doing all that. But you need to do some semblance of homework, okay? I'm not saying you read a 200-page SEC filing, but you need to know what this company is, what sector are they in, because the biggest thing is you need to be trading hot sectors as a new trader. You need to be researching the float. You need to be looking at the past chart history. You need to know, and again, I'm not saying you got to spend hours reading filings, but you need to know, have they done past dilutions? Okay, am I gapping this huge runner that has a history of diluting every time they run? So you need to do some homework. I'm not trying to scare you away. Have a process. I talk about those swing trading sheets, the gapper sheet that we use that checks off the boxes on whether or not this stock is a gapper, but avoid that fallacy of just trade the Momo, bro. That's not, you need to do some research, especially float, chart pattern, history of dilutions, sector, industry, etc. Number 4 is very similar to number 1, but slightly different, and that's following too many gurus, alert services, newsletters, etc. I mean, hey, listen, I work with a mentorship program in the Steady Trade team. Again, I issue blog posts about swing trades. I do all this stuff out there, but I think what a lot of newer traders get tripped up by is information overload. Okay, and there's a ton of them out there. There's a ton of great, valuable information, resources, training materials. Last thing I will ever, listen, I'm Mr. Positivity. I'm not here to bash anyone. There has never been a time better to learn and for information. But, and I did this too, I basically made all these mistakes. That's why I'm trying to keep you from making them, because I made all these bonehead mistakes. When I was getting started, I bought everything. I bought DVDs, books, courses, logging into 5 different chat rooms, And it was just too much. So my point is, if you're taking a course, focus on that course. Just that one. If you're reading a book, it's just that one. If you're in a chat room, just that chat room. Find out if it works for you. Now, ultimately, you might be in a room and you're like, not really my style. They trade OTCs, or they short stocks, or they're trading high price stocks. But don't sit there and try to log into 5 different chat rooms, 5 different alerts, taking 4 different courses. Focus, because there's so much information out there, and you're just gonna, it doesn't work. Last thing is, and I think this is so important, is not keeping a journal, not tracking your trades, and not keeping track of your mental state, your emotions, your growth process, etc. And I hope all of you know you should be tracking your trades. Okay, you should have, whether it be a spreadsheet or whether it be an app or a database or Evernote or whatever it is. I think most of you are going to be like, yeah, Tim, we get it, tracking trades. But where the journal comes in is saving charts with your entries and exits so you can look back and see those chart patterns. Most of what we do is chart recognition. The more you can cement that, the better it is for you. And then I know this is a little foo-foo, okay? I'm not telling you to get out the crystals and the patchouli oil and the hemp oil and burn some incense, but I'm telling you, you need to be aware of your emotional state, where you are at mentally. And, one of the things I love about the Steady Trade team, Kim Ann Curtin does a lot of this stuff. And, I mean, I get it, okay? Listen, I'm as much a caveman as they get. I think I'm like 12% Neanderthal or something, but I'm basically a caveman. But something that I learned in my trading career is I need to know where my mental state is. And if I'm not sleeping right, if I'm arguing with the wife, if I got outside pressures going on, projects going, boss yelling at you, whatever is going on, it's going to translate to your trading. So keep that journal, track your wins, your losses, and I'm telling you, even if I say reread it, but even if you don't reread it, it's valuable information. And we did a recent podcast a few months ago. I went back and pulled back some journals from 2007, 2008. It's interesting. It's also just fun to kind of look back and be like, whoa, I thought that back then. So it's a great way to learn and grow. And I think, I don't care what you're doing. Journaling is so important when it comes to improving, whether it's fitness or, you're cooking or, anything. You could track that. I think it was Peter Drucker said, what gets monitored gets improved. I butchered the quote. You can Google it. You know what I mean. But by reviewing and tracking, that's how you improve. So thanks, everyone. I hope this was valuable to you. Again, I know it's more sexy to talk about big gains and buying here and boom, pow, and all those cartoon characters I talked about. But again, as a newer trader on that path, there are so many things looking to trip you up. If you can avoid these 5 things, I really think it can help you improve and shortcut that path to success. And speaking of that, be sure to click the link below and check out the Steady Trade team. It's the mentorship program I mentioned. We go over so much. It's a great small group, and I think it's a great way to really speed up your trading in these wild markets.